Hello, Propenomix people, and hello, Property and Propenomix people. Thank you for tuning in. So, this week's supplement was called Split Decision, and you'll soon see why. And if you've watched before, you'll know that I like to start with a quote. So this week's quote that I chose was, "In a way, the philosopher and the barber are of the same guild. The barber cuts hair, and the philosopher splits hairs." And that was from Jose Ortega y Gasset, who was a Spanish philosopher. So the quote is all about what I'm talking about in the deep dive today. There won't be too many people who are going to discuss the historical context of this week's Bank of England cut in rates by 0.25% or look anywhere near this deep. But then there's every chance that's why you're watching this video and you're hopefully a subscriber to the channel. If you're not a subscriber, please crack on and hit that subscribe button as it helps out the channel an awful lot. Thank you. But before I go in full hammer, I just wanted to mention Rod and my own property business workshop that's being held on Wednesday, the 1st of October in London. The subject matter this time around is investment, with an emphasis on what metrics you really need to be considering to run your property business properly and building your business to scale. We'll be digging into the real fundamentals of property investment for growth, from proper valuation and strategic debt structuring to the investment metrics that serious pros use. So we're not talking ROI and yield here, just to be clear. Learn why some deals work for some and not others, how to manage risk as your portfolio scales, and when to shift gear from side hustle to scalable business. We're going to break bottlenecks, build strategic pillars, and unpack real-life case studies of fast company growth. How have we done so many deals? We'll tell you. Book those super early bird tickets with 20+% off the face value of the prices at bit.ly/PBWEIGHT. And there's also a link in the show notes. So I'll be kicking off today with, as has become necessary, Trumpwatch. It was a fairly big week on the tariff front, apart from anything else. So there seems to be a reasonable amount of media noise around the actual incidence number of US tariffs at the moment, but it's a UK VAT style 20% is the number that seems to be sticking, although I have seen as low as 15% being reported on average. Now, bear in mind, they already have sales tax at the state level in the US, so this is kind of VAT on top, if you like, of a sales tax. And this is actually the highest since the 1910s. On Inauguration Day, the average tariff rate was 2.4%. So perhaps we should be saying, make America expensive again. India is paying the price for dealing with Russia as well, or at least that's how Trump is framing it, at 50% after an additional 25% was slapped on Indian imports that was in the last week, supposedly commencing August the 27th or somewhere before mid-September, depending on the exact product being tariffed. Translation, probably Trump wants a different deal with India. A Trump loyalist was also appointed to the Federal Reserve Board. I wonder which way he'll be voting in future votes about cuts to the interest rate. It looked rather strange in the UK system, that's for sure. If you had one person simply voting for a 3% cut or similar at each meeting, that's what Trump said. He wants rates down to 1%. When everyone else was either voting to hold the rates or cut them by 0.25%. But the official line is prioritising employment over inflation, which of course is quite simple to achieve because you just change the inflation targeting system into an employment targeting system, which is widely accepted as the central bank's second priority anyway. But the reaction in the bond markets of actually doing this would be inherently volatile, since the lenders, when they aren't the government or the Fed anyway, are much more concerned around inflation than they are about unemployment. So what I'm saying is bond yields could spike significantly if inflation targeting was officially or unofficially moved away from as a policy. Anyway, what continues at a more macro and philosophical level and is playing out in real time, investors are busy asking themselves, what is a safe haven asset? Simultaneously, you might have heard about the executive order last week, which broadened what 401k plans can invest in the US. That's the most commonly used retirement plan wrapper in the US. What can they now include? Well, private equity, real estate, and crypto. That's not an immediate change, much as it's been framed as one. Regulations need to be updated, possibly up to a year's worth of work, depending on which asset class you're talking about there. And then the plan providers need to react themselves. I don't suppose the big providers will fall over themselves to hurry this along. But then again, I wouldn't count out another executive order if Trump doesn't feel like he's getting his own way. The best analogy would be making an asset class that's currently only available in a SaaS or possibly in a SIP as well in the UK, available to those who invest via the government pension schemes through their work PAYE Nest plan or similar, with their defined contribution pensions in the UK. So a significant change. But always an interesting week, and the global consequences of the tariffs are causing most organisations to revise their global growth forecast downwards. The IMF revised theirs upwards, but the big organisations are basically forecasting around about 3% global growth and similar for 2026. So over to our favoured subject matter on this side of the Atlantic, the real-time UK property market. Chris Watkin was back with week 30. Listings printed 33,700, which was a slight uptick from 33k as the school holidays continue around the country as far as the figures go. And we're now only 4.1% higher than 2024 year to date and 6.9% higher than the pre-pandemic market. My 10% more stock than the normal market ready reckoner is still working on the back of about 2 years of overperformance in listing. We're about 12.6% ahead of the 9-year average, but that does include the year 2020, which pollutes the figures somewhat because we had months where we weren't listing any properties at all, of course. So we're not verging further forward into the even more listings than historically precedent. If anything, we're dialing back a little bit compared to what we were doing in 2024, for example. But we are still listing more than we're selling, so listings are still just about going up. But it's all about the withdrawal rate, really, of stuff that doesn't sell. So only 22,700 price reductions in week 30. 14.1% was July's official number for price reductions. 14% reduced in June. Last year we had 12.1. May we had 13.4. And the 5-year average is 10.6. So you're seeing more stock and therefore you're seeing more reductions, which is absolute and relative as well. 33% more reductions than the 5-year average if you take the difference between 14.1 and 10.6. 25% more reduced properties than a normal market also works as a ready reckoner. 1 in 7 properties on the market are being reduced each month. So we're currently running at nearly 100,000 price reductions per month, to be clear. Can't find a deal? Just keep up the legwork and you'll get there. You don't tend to see 14+% of stock being reduced in strong markets by any stretch. This is very much a sideways market at the moment. 26,900 homes sold subject to contract. 900 houses up on the week before. Healthy is still the watchword. Sold subject to contracts are up 7.5% year on year and 14.8 on 2017 to 19, and still nearly keeping pace with 2022, which to this point was a very hot market indeed. We went into August with 763,178 homes on the market, which was about 5,000 more than we went into July with. For a bit more context there, as the market was a bit stickier before the pandemic, we had about 660,000 on the market. The seller's market looks more like 600,000 or fewer on the market. At the end of July 24, 716,000 were on the market. So you can see how much higher you are. So it's nearing that sort of 10% bracket, although it's being clipped back quite a bit because 763 over 716 is only about 50,000 more or a shade less. So about 7 or 8% more stock on the market. Not maybe the glut we were seeing some time ago. But there are more higher highs. And so this flat feeling that I've been talking about for some time now is just going to continue to manifest itself throughout the school holidays. I think it's the second month, though, in a row of not really seeing more listings or many more listings in total on the market. So, you know, fewer than 1% more homes on the market compared to the month before. So are we at the peak? I'm asking myself. You can't read too much into August activity anyway. There's always an extra surge in September when school holidays are over, alongside a clear out of no hope of stock where vendors mostly can't take the medicine the corporate agents are trying to prescribe for them. So we probably need to see those figures before drawing conclusions, as they could be somewhat different this year with just so much stock out there on the market. Chris is also looking at the per square foot on sold subject to contract properties. A very strong correlation with prices that hit the land reg in 5 months' time. So July was £344.78 a foot, which was 1.97% higher than July 24, 3.85% higher than July 22. It was down about 0.5% on June's sold subject to contract number, which is just over £346 a foot. So I think we're still looking at about 2.5% up market now for 2025. A little bit under my prediction, which was 3.75, but below inflation, wage rises and the likes. You know, my prediction was very much based on where I thought wage rises would be and where I thought inflation would be by the end of the year. We haven't kept pace with that, which on the bright side means affordability for people in general has been improving. But the risk of being a broken record, really, it's sideways, sideways, and sideways, and a little bit down in real terms after you've adjusted for inflation. And then fall throughs nudge back below their long-term average of 24.2. They printed 23.6. It's all relatively normal noise. There's a very small amount of volatility around that long-term average for many weeks now. Net sales are playing ball, 20,600, 5.9% up on last year, 10.5% higher than the pre-pandemic market. Not quite 2022 levels, but the stamp cliff, of course, has forced a few transactions out of bed, disturbed the market a little bit. As this year progresses, if we deem that the stamp duty thing has kind of washed itself out now, you still would expect fewer transactions in the longer run as a rule per house or per household per year, or however you wanted to measure that, because stamp duty is higher. Frictional costs of moving are higher, and that just jams up transactions. And that's what we're going to see over time as we crack on, I think. Let alone if stamp duty were adjusted again, not that I'm suggesting it will be in this budget, so don't panic too much on that one. But, of course, at the end of 2022, we saw a massive disturbance in the bond markets apart from anything else. And so transactions started to drop off significantly towards the end of 22. There's no reason why that would happen again in 2025 that I can see at the moment. But I always give Chris a bit of a weekly shout out because he's much more prolific than just this epic tome that he releases weekly on the UK property market. He comes with great stats on a regular basis. I recommend you drop him a like, subscribe, and all the rest of it, and some kind words for his content creation. If you're in the industry and you want support in growing your business to be a more effective communicator and be more in touch with your local market, that's his core business, so give him a shout. His article also gets published on the Property Industry Eye website and the video on his YouTube channel, which is @ChristopherWatkin. Okay, we go into the macro vortex as all the metrics spiral together as usual. The final PMIs were out. Once again, an improvement on the flash numbers, but just as per the housing market, as this economy continues to look more sideways than upwards, not as good as last month's promising figures, sadly. Halifax released their house price index under minimum fanfare because a normal-looking month doesn't really garner any column inches. A few of the lesser metrics will be caught in the Bank of England committee wash-up that's coming in the deep dive, which leaves room for the real-time indicator report, which is a weekly report from the ONS that I like to look at whenever there's a little bit of space, probably once every 2 to 3 months. And then, of course, we've got to look at the gilts and swaps to finish off, especially in a week like this. So the PMIs, we saw the flash numbers. They were a fairly big drop on the June numbers, which were surprisingly positive. But then we had the same with the June flash numbers. They printed a lot lower, and then they were revised upwards in a big way. July was no different. So how did the headlines go? Well, they described it as a modest increase in sector activity. That's usually the narrative when your number's sitting about 52, as it was in services. The flash number for services, 51.2, was revised up to 51.8. So we're on the right side of 50, not with a lot of margin, and dropped from last month's 52.8, which is a much more healthy number. But the other headlines, well, a renewed fall in total new work and the sharpest decline in employment since February, as the private sector simply continues to reel from national insurance increases and the cost of employing people having gone up even more at the tail end of extreme wage inflation, alongside extreme price inflation, don't get me wrong, but this is the third month in a row above the 50 handle or in actual growth territory on the bright side. This total new work contraction can't be ignored. The fastest fall since November 2022. Yes, I know I talk about that time period every week. What's the narrative? Well, weak client confidence, which is believable, and delayed investment decisions. After the budget now, mostly thanks to poor communication, if business taxes are not going up. Export sales fell as well, although it wasn't as bad as the month before. In theory, the tariff regime is largely set now, so export certainty should start to return somewhat. What's theory worth, though, with Donald Trump in the White House? For 26 months in a row now, there's been a reduction in the backlog of work, and also hiring freezes and redundancies continue thanks to inflation and lack of demand. Cost pressures are described as strong by firms. 44% see an expanding year of activity ahead, compared to 12% forecasting a reduction, which is a robust sign of confidence and one of the better ones I've seen since the negative budget chat started in September 2024. So just to round up from the economics director really then, couldn't maintain June's growth rate. True. Hiring trends especially subdued, with rising payroll costs the main factor. Currently 4.1 is in the books for the national minimum wage to increase next year. Not quite finalised yet. but it's going to be in that sort of shaker. And probably as inflation's going up, it'll probably be a bit more than that, to be honest. Concerns about tariffs are receding. Certainty or near conclusion is always better than fear or the fog of war, though, every time. So hopefully those tariff concerns will start to abate in the second half of the year. There are hopes of a boost to spending and to business from lower interest rates. Well, I'll talk about that a bit more expansively in the deep dive, but covering manufacturing very briefly, the final print was 48. The flash was 48.2, which is still in downwards territory, but it is actually a 6-month high. So that's basically saying the national insurance damage has nearly been absorbed, but not quite yet. Tentative encouragement was a good phrase that we used in this report, but no assured path to strong growth certainly resonated and sounds like the entire economy at the moment. Construction is closer to our hearts, and instead this was an abject disaster of a number. The headline in the construction PMI report, the sharpest activity contraction in over 5 years. Now, you know what happened just over 5 years ago, so we might as well ignore COVID and you have to go back to other crisis events to find similar contractions. It was described as a renewed decline in housing products as, apart from anything else, Labour refused to believe or just don't understand what a block the Building Safety Act is placing on urban development projects at any meaningful height. The report opened with the words considerable slump. Now, no one's going to enjoy that. The print was 44.3, down from 48.8. And the expectations were a print around 49, not around 44. That's a huge miss in the predictions in the PMIs. We very rarely see anything. I can't remember the last time I saw a miss of that magnitude, having been looking at the PMIs closely for years. Lower volumes of new work incoming, weak confidence, less work undertaken on public sector projects. Civils actually took it the hardest. Payroll jobs continued to fall. It's a miserable, unexpected, rapid fall, although relying on house building to hold up what has been a weak year for civils and commercials is always a concern when the underlying conditions for development are clear to me, who has confidence in his own forecasts, but not yet evidenced by a healthy enough market. Many of the players prefer to wait for a little more certainty before acting, and that won't come until the end of the year or the beginning of 2026, frankly. So the overall economy growing maybe at 0.1 to 0.2 per quarter, we would hope, just based on that month's PMIs. I mean, it's tragic to be speaking a statement like that, isn't it? I first used the notion of treacle in the supplement in late 2022 to give you this sort of image of us plodding through and getting footsteps stuck in the treacle instead of really pushing forward with this economy. And indeed, that's what we've seen since then, mostly because of fiscal drag, the amount of debt that we've got, also inflation always causes an issue. And this period has been no different. In fact, it's been a very, very testing period for inflation, as you know. But maybe we can cheer ourselves up with the latest Halifax house price index. Well, it's the best monthly number that Halifax has posted since January, 0.4, up from 0.1 last month. Their annual growth rate, 2.4. Their head of mortgages chooses to remind readers the challenges remain for those looking to move up or onto the ladder, but points out that, again, affordability is gradually improving. She closes by saying we expect house prices to follow a steady path of modest gains through the rest of the year. So that's a 0.5% drop in August then. The commentators curse, but joking aside, they sound a little more bullish than I do about this current sideways market, or they're expecting these more flexible affordability assessments, as they've been describing them, to kick in a little quicker than I do. Given they have all the data, they might well be right. But remember, when you compare Halifax and Nationwide to, say, the ONS, which is the Bible of house price movements, of course, because it does pick up all of the transactions, or all the transactions above 40k anyway. What Halifax say in June, July is really what happens at the ONS at the end of the year. There's that sort of level of lag that we're talking about. So perhaps I'm expecting by the end of the year things to start off improving in terms of transactions actually happening. So perhaps Halifax are just calling that now in terms of mortgage approvals that they're seeing put forward. And we know mortgage approvals have done well because we reported on that last week in the Bank of England Money and Credit Report. Did better than most people expected, nearly at the 65,000 mortgage approvals per month, which is a sign of a healthy market. So Amanda Bryden, the head of mortgages, continues by pointing out that whilst those dropping off 5-year rates are going to be paying more, those dropping off 2-year rates are now looking at lower 2-year rates. And so that's a big help in average rates and payments being made compared to everyone dropping off a lower rate and going on to a higher one. So of course that's true, although you have to bear in mind like 3/4 plus of mortgage business of late has been at the 5-year fixed level rather than the 2-year fixed level. So into the constituent countries, then Northern Ireland is still ripping it at plus 9.3% year on year. Scotland comes in at 4.7 compared to Wales at 2.7. Halifax has still got the Northwest leading at 4% year on year increase, alongside Yorkshire and the Humber, with the Southwest, London and the Southeast at 0.2, 0.2 and 0.5 respectively are laggards on their data. So still struggling along roughly at break-even level, which obviously means inflation is eating into them. Wage increases are eating into things, so better affordability in the south of the country, realistically, but nothing of concern anyway. Interesting to see, probably that's their most bullish call in years, to be honest, Halifax, but it's more a sign of how negative they've been than how bullish they are today, which is suggesting this steady path of modest gains. Now, you know where I am on it, still seeing sideways at the minute. I'm not moving this week just yet. Real-time economic activity and social change indicators then for the week. So transaction data from Revolut is showing a small increase in spending in the 18 to 34 age bracket over the past 2.5 years, but much larger increases from those who are 35 plus, who seem to be doing a lot better than they were. Direct debit failures are trending upwards from 1.87% on the turn of the year to 23 to 2.26%. And it's a steady path upwards, which has started to flatten out, but still not a trend that anybody wants to see. The percentage of direct debits in people's accounts that fail. The average transaction by direct debit in that time period is up only 5.57%, which is an interesting measure of inflation, which is running a lot higher than that, showing just how much people cut back when the price of something goes up, I'd suggest. The number of online job adverts, unlike the ONS figures, is looking about level with 12 or so months ago. That's the most positive looking piece of jobs data I've seen anywhere for a while. This is a comeback from an epic drop-off after what looks like it was the budget in October 2024. Redundancies also look fairly flat over that entire 2.5 year period, with many peaks and troughs, but as a trend line. So system prices of gas and electricity look a lot more stable than they did in early 2023, and a good chunk cheaper, as you'd expect. Gas looks particularly promising. On renter affordability, they get their data from Dataloft. They have 29% of gross income now being spent on rent versus 26.4% in January 23. So on average, affordable, because the ONS use 30% as their affordability metric. Most agents use 33.3% as their metrics, so that would change things. But you can see if you're at 29 on average, it's going to put nearly 50% of all renters in the unaffordable bracket, according to the ONS metrics. UK flights look an awful lot healthier, with steady year-on-year increases in air traffic as well. Ships visiting the UK, however, are down and seem to be trending downwards. Doesn't seem to be a lot in it, but maybe it's fewer imports, maybe it's just lower spending on goods overall, but it's not a direction of growth. It's always interesting stuff, and this real-time data, you get a really different picture to what we're being told or what we measure using the big, high-level, grandiose metrics. I always prefer real data to survey data, because often surveys are asking what we're thinking of doing rather than what we're actually doing. Even when they ask the latter, often people answer about what they're thinking about doing anyway. Anyway, that leaves us with the gilts and the swaps. It's worth repeating what I've said many times before. A cut in the rate, particularly one that is deemed to be guaranteed, i.e. a 90+% certainty, may well not lead to a drop in the mortgage rate. Now, this is often misunderstood, but when you think it through, it really isn't a surprise at all. The market prices in the future price of Bank of England rate, and then discounts that information depending on how far away the next decision is and how certain it is, of course, as well. It doesn't go into Wednesday thinking, oh, well, the rate is 4.25 and then gets surprised at midday on Thursday when the committee votes to cut the rate. The surprise would have been if the rate had been held, as I've discussed over recent months. I thought it was a closer decision than the 92+% probability that was being attached to that rate cut by the market. So instead of a 0.25% cut in the price of short-term money, meaning a 0.25% cut in the price of a 5-year mortgage, it's possible it has no impact or even raises the price of 5-year money if the market interprets the cut as uncertain or indeed incorrect in the circumstances. Like I was saying earlier on, if you just went on and voted US interest rates down by 3%, you'd see a revolt in the bond markets, because what they'd be hearing is, we're not worried about controlling inflation. And that's a big problem for bonds. So in this particular case, we'll get into the Bank of England vote in the deep dive, but we opened the week with the 5-year gilt at 3.972. It wandered down ever so slightly to 3.95 just before the meeting. And then when the news broke that the vote had been very, very close, but a cut was indeed the outcome, it hardened to more like 4% and closed the week after a small drift on Friday afternoon to 4.041. The consensus would be that the committee would be largely united in cutting the rate. That didn't happen, and that was deemed to make future rate cuts less likely in a particularly timely fashion. The market reacted. On paper, mortgage rates went up, not down. Thursday's close of 4.011 on the 5-year yield translated to a 5-year swap yield of 3.661, preserving that 35 basis point discount that we've seen for months and months now. The yield is incredibly flat, given that the first cut was a year ago in this cycle, as far as the base rate is concerned. 5 cuts in, and the 5-year swap rate has moved from 3.656 1 year ago to 3.661, i.e. not at all. 5-year mortgages have not got one bit, not even 1 basis point cheaper. Throw in a 5-year swap rate of 3.68 1 month ago, and you just start to get this picture of an incredibly flat 5-year swap rate. Different on the 2-year rate, as we might expect, mostly because the yield curve has flattened where it was inverted before. So 12 months ago, the swap rate of 4.062 was more than 0.4% higher than Thursday's close of 3.634 on the 2-year swap. But still, it's 0.4. It's not 1%. It's not 1.25%, which is the cut in rates we've seen in that time. But this path is largely the path that was priced in about 12 months ago. Flattening of the yield curve maybe came a little bit quicker. We haven't had the recession that normally happens, but this is primarily because of where the rate was. And you could argue the Bank of England did a pretty decent job in settling at 5.25% in terms of managing this upward cycle in rates. I know many people wouldn't necessarily agree with that, but we've managed to get through that period without a recession, and now we're going to start to see some economic benefit of lower interest rates starting to kick in now we're 12 months into the cutting cycle. But we've also had this economic slowdown, which has been taking place primarily because of the fiscal policy that's been implemented by the Labour Party. So maybe there's not too much in there to surprise readers, although if you go into rate weeks thinking, 0.25% cut in rates means 0.25% off mortgages, you would have been disappointed and surprised. The 30-year gilt's also hardened, so we're keeping an eye on the longs at the moment as well. The 5-year yield was up a tiny shade under 7 basis points, as we said. The 30-year only hardened by 4 basis points. So the steepness of the curve actually softened a tiny bit. And that's what you would expect to happen in a cut week where a highly likely cut is confirmed, but it didn't turn out to be highly likely at all in the end. So this is why the gilts have drifted upwards and why the 30s haven't drifted up so much, because they're not so affected by the particularly short term, whereas the 5 years are obviously much more short term than the 30s, right? So when things don't move as we would expect, and this is, I know this gets a little convoluted, but when things don't move as we would expect, so, you know, we cut rates, but actually gilt yields went up, it's a very advisable to keep a close eye on the market. But what it's the market signaling to you there is probably the direction of travel is now going to be drifting upwards in the yields until that next bit of data comes along. You know, in economics, they like to use the phrase ceteris paribus, or all else being equal. All else is never equal because everything else doesn't stop and wait for one macro metric to change. The next macro surprise, as in the next missed forecast, is only just around the corner, such is the nature of forecasting in general. But outside all of that, the 30-year gilt still returns 5.427, and I still continue to see plenty of posts on LinkedIn and elsewhere about what good value that offers for a truly passive return, which has been in line with my own thinking to an extent. It isn't enough to excite me, don't get me wrong, but I'm talking as if I was a pension fund trustee rather than a private individual in his 40s who's still willing to put in extra effort to receive stronger returns. The big players in the market look at these risk-free rates of return and they consider them, and it changes the percentage they allocate to riskier asset classes dramatically. Bonds at these prices will continue to be popular for long-term players, without a doubt. So that does all lead us rather neatly into the Bank of England meeting in the deep dive. And just as a reminder, this was a meaty one. These are the quarterly meetings where the interest rate decisions are really made in a more steady state environment, the ones where a full Monetary Policy Committee updated report is published, forecasts have been refreshed. This wasn't so important when the interest rate was climbing, And we had incidents to deal with, such as the trust budget, which changed the course of history. At the time, the committee knew the rate needed to go up significantly, and they didn't know early on whether they were going to stop at 3%, 4%, 5%, or even higher as they ended up, although they were pretty emphatic that 6% would not happen. If you recall my talking about that when we got to the meeting after the trust budget. But while we're in the slower cutting cycle, the cycle that, in fairness to the bank, they have been predicting and talking about for 18 to 24 months, and they've been delivering for 12 months now, cuts are simply not occurring at the meetings where there are not updated and refreshed forecasts and there are not full monetary policy committee reports. I've been pointing that out to anyone who will listen for some time now. Now, why is this? Well, there are two reasons, really. The real and substantive one is that the members of the committee, they want new, updated information, and they're predicting the economy in 6 to 24 months in advance. The forecast period is 36 months in advance when they're voting to change the interest rate at all. Now, the other more cynical and less substantive reason is that it gives the appearance they're completely on top of what they're doing. In central banking, slow and steady wins the race, and the confidence of the bond markets. It's all very predictable at the moment, or it has been, especially a few weeks out from each meeting. There haven't really been any surprises, although that wasn't the case this month. We didn't have a surprise outcome, but I expected 2 or 3 holdouts, 2 or 3 people who wouldn't vote to cut and would therefore vote to hold the rate. Last time out, we maintained the rate 6-3, right? And as I say, it's a loosely meaningless meeting, really. 3 cutters, 6 holders, but that was really signalling there's probably a cut next time out. The holdouts I expected this time were Hugh Pill, who's the chief economist, because he's been pretty clear on his position. Catherine Mann, external member, because after a flip-flop, she's been clear on hers. They were my bankers, if you will. And then Megan Green, harder to predict because she, in my opinion, is the one who's really, really close to exactly where the MPC needs to be. I think she's very, very dialed into what the UK economy needs in terms of its monetary policy. And this was a bit of a knife edge vote. But if you put a gun to my head, I probably would have predicted 7 to cut and 2 to hold, with my second bet being 6 to cut and 3 to hold. But you might not realise just how close the meeting was or the historic moment that occurred. The committee voted. Now, the first vote is a free vote, right? And the first vote was 4 to cut by 0.25%, 4 to hold, and 1 to cut by 0.5%. Now, the fourth one who voted to hold was the Deputy Governor for Monetary Policy, Claire Lombardelli, and that's the one that I didn't see coming. It's the first vote where the Governor and the Deputy Governor have disagreed. Right now, other Deputy Governors, there are 3 Deputy Governors on the committee, but this one, Claire Lombardelli, is the most relevant by far as this is concerned. This is her committee. This is her remit within the bank. You know, she's Deputy Governor for Monetary Policy. So she's the big one. So that's the first time since the you can look at it 2 ways, really. It's the first time that the Governor and the Deputy Governor have ever disagreed while Andrew Bailey is the Governor. Now, the Deputy Governor for some time to start with is Ben Broadbent, right? That was from Bailey joined the committee. His first vote was on the 19th of March 2020. What a great bit of timing that was. But it's the first time, really, you could say either the Governor has felt confident enough not to follow what the Deputy Governor is saying. That's one way of looking at it. I mean, I've certainly... she would be deemed to be the most senior expert in monetary policy on the committee by virtue of her position. So it's quite a big deal for the Governor to disagree with her. But indeed, he did, right? So I personally feel that and that's probably good leadership, to be honest with you. You let the Deputy Governor certainly influence you strongly in what to do, but you've still got to be strong enough to disagree when you're the chair, of course, and that's what's happened this time out. I would think you want to trust your resident expert usually, unless you've got a strong reason to disagree. It also, of course, when they vote the same way, it shows unity to the world. I mean, it doesn't compare too much when you consider you've got a US president who makes up schoolyard names about the top boy at the US Federal Reserve, but then we're not the United States, folks. Lombardelli had followed this same pattern of agreeing with the Governor all the way through until Thursday. On Thursday, she was the 4th dissenting voice to hold the rates. Now, it won't surprise you to realise they've thought about all this stuff before, right? There are 9 people on the committee. The whole point of having an odd number is that you're going to have a winning vote. You don't call in sick to a Bank of England meeting. The governor's got no golden vote or casting vote power. The first vote is always a free vote. You vote for what you want. If you think we should cut more quickly because you think, for example, the economic malaise caused by national insurance rises and poor fiscal policy, sending unemployment upwards, is a more immediate threat to economic stability than the current inflation number being north of 3% or north of 3.5% indeed, you might want to cut more quickly. This is exactly what Alan Taylor, the external member, did this time around. He's outed himself as being even more dovish than Swati Dhingra, who's the external member who's been voting to cut since February 2024. And again, she's been very publicly clear on her opinion, and therefore she's easier to predict. In February this year, she joined Taylor in voting for a 0.5% cut rather than a 0.25% one. And we had a strange meeting where the report was 7-2 in favour of a 0.25% cut, but in reality it was an emphatic cut at 9-0, because the two dissenters, who were Taylor and Dhingra, were only dissenting on the size of the cut, and they wanted a bigger cut rather than saying, should we cut the rate or not? So I know this might seem like a fine level of detail, but every single word not said, every single detail is analysed at the top level by the markets, who react when they see things or hear things that they do not like. There's a lot of money on the line here. The price of the national debt depends on it. That's the last time you'll get anything that looks remotely like an apology from me at going into this level of detail. But this time around, the vote was different, perhaps because Lombardelli surprised really with her actions, and it certainly surprised me. Last week, when I looked, the consensus for the vote in the economic community was 8-1, which I thought was a bit strong. But instead, as we led up to the meeting, it looked more like 7-2. So we knew there were 4 who preferred to hold. The commentators really knew that you would see Pill and Mann holding. We suspected that Green might, but no, Lombardelli, I didn't see a single person or a single article say that might happen. And her role is really very significant, right? An external voting the way, it's very different. You know, you've got 4 externals on the committee and 5 internal members of the bank, the governor, the 3 deputy governors, including Lombardelli, the big one, and the chief economist. If those people disagree, that's more significant than the externals doing what they think is right, who are kind of deliberate loose cannons, if you like. And loose cannons are a bit strong, extremely well qualified economists. But that's exactly what happened. So first vote was 4 cutters by 0.25%, 4 holders, and 1 cut of 0.5%. And then there's on the Bank of England voting sheet, which is it's the first time in the history of the central bank they've had a side note on the voting sheet, which just clarifies the chair invited the committee to vote on the proposition that bank rates should be reduced by 0.25 percentage points to 4%. Alan Taylor preferred to reduce bank rate by 0.5% to 3.75. In order to secure a majority decision on bank rate, the chair then invited the committee to vote on whether bank rate should be reduced by 0.25% to 4% or whether bank rate should be maintained. Alan Taylor, as you would then expect, voted for 0.25% reduction, and this vote is recorded in the spreadsheet for August 2025. So the point of order is he really wanted 0.5% cut, but the vote recorded in the spreadsheet is 0.25% because that was the meaningful vote for him. So really, he really voted 4% star or whatever you'd like to call it, rather than anything else. And hence it was 5-4 in favour of a cut, or it only just scraped it, is the closest it can be, of course. But I think we know where Alan will be next time out. It's interesting that Dhingra wasn't with him in the 0.5% camp again, as she was in February. So she must have started to get more concerned about the re-emergence of inflation this year, and she must be so sceptical as to how sure anyone can be that it is completely transitory, especially as we go on through the minutes. You'll see what was presented to the committee. But this would, all else being equal, mean that next meeting, where we don't have an updated forecast, which is Thursday the 18th of September, there's Buckley's chance, as the Aussies might say, of another cut. But November, on the updated forecast, still looks possible for a cut. Certainly not everyone has changed their position as yet, but some commentators have. The market path currently looks more like a February 2026 next cut, which was in line with my own predictions, rather than expecting a November cut. So I'm obviously inclined to agree with that. I haven't had to change my position significantly there. My position at the beginning of the year was 2 cuts this year. We've obviously had 3 now. It's unlikely, it's possible, but it's unlikely we'll see a rise before the end of the year. So it looks like I've probably missed by 1 cut, but not by 2 cuts, as much of the market and many more commentators said we'd go lower and lower and lower. I think possibly because they were expecting a bit more of a meaty recession rather than economic slowdown and fiscal drag and the policy drag we're seeing for the national insurance price rises and things like that. But the MPC might, apart from Alan Taylor, want to see CPI on a downward path again, to be sure. And when you think about how it works with the inflation numbers and the dates of the meeting, the most recent inflation numbers that will have been released by the time we get to November's meeting will have been September's numbers. The bank now think that September's inflation number, CPI number, will be 4%, which is a different level of worry to 3 point something. And it would be really, really tough for them, as they would have had inflation then presumably rising up to that 4% in over a course of about 6 months or so. It's going to be very tough for them to continue to cut rates below the 4% mark, I think, in November. So I'd be much more confident there's going to be a hold than anything else, much more confident than the market is at the moment anyway. But at this point anyway, after a quarterly report meeting, I usually get into the summary of the minutes. It's not going to be different this quarter, but the preamble was particularly important today as it gives the market huge clues, some which I'd already suggested by reading the tea leaves a little better than many of the mainstream forecasting houses. Although, as I often say as well, I don't have an agenda, they often do, so I do get to say what I think rather than anything else. Now, I also want to say I broke ranks on socials this week and I was compelled to comment on Keir Starmer's post on Facebook. We claimed credit for 5 interest rate cuts since taking charge. This is probably just pure politics, and I should let it go. But either his position is inherently disingenuous, deliberately, or accidentally. And it's the latter that has me worried. Does he not realise that this kicking and screaming cut from 4.25 to 4 is indeed because of Labour, because of the damage they've done to the fragile growth in the economy, thanks to the national insurance tax rises, because of the weak policy statement not to put taxes up on working people, the manifesto pledge that's already been broken anyway? Do we need another budget that freezes both business and consumer confidence, doing yet more economic damage, another wasted quarter of our lives, realistically, from an economic perspective, before we realise that putting rates down because you're doing a naff job is not something to claim credit for? I had to speak. Last time I checked, I had 2 likes on my damning comment. Obviously, I'm a true influencer. And one of them was from Rupert Lowe. Yes, the verified real blue-ticked Rupert Lowe. Oh, yay. Anyway, back to the matter at hand. Off we go then into the summary and the updates from the last quarter out. The bank reports on substantial disinflation. In case we forgot the 11.1 in October 2022, this cannot be denied. The progress allowed for the rate cuts, true, very little to do with the Labour Party, although arguably this one was, but for bad reasons, not good ones for Labour supporters. There's a reminder that the target is 2%. Well, you know my thoughts on that. I think 3% is the new 2% personally. And the committee remains focused on squeezing out any existing or emergent persistent inflationary pressures to return inflation sustainably to its 2% target in the medium term. And yes, they do have to say that. There's recognition of Q2's inflation number of 3.5%. They prefer to think in quarters, which makes sense, rather than months. As I discussed, they only make a decision once a quarter here at this point in the cycle, apart from at very wobbly times, and they've blamed developments in energy, food and administered prices. I mean, that's very apolitical because all of that is happening, and they do go into it a bit more in the report and talk about the pressure that national insurance rises has put on to especially food inflation, aside from anything else. And they do recognise that there's a British Retail Consortium that think food inflation will hit 6% by the end of this year, which is terrible news for people on lower incomes apart from anything else. But they do recognise the elevated pay growth with some recent decline, which is true in that camp. And also they recognise that services inflation has been flat over recent months. They then refer to their updated forecast of inflation to 4% at this point for CPI in September. There's another looming black hole for a government because this is the CPI rate that sets inflation-linked rises for the government for 2026. Feeding into the OBR forecast for the next 12 months to be released just before the budget in late October. Yuck. After then, according to the report, inflation just innocently falls back to 2%, probably, so they say. There's recognition there might be additional upward pressure on the wage and price setting process. The wage price spiral they've always been concerned about, but that hasn't really formed a part of this inflationary cycle that started during COVID. Instead, people have been scared, so they've saved that extra money that they've been paid rather than consuming it. So overall, medium-term inflationary pressures are judged to have moved slightly higher since May. No kidding. Growth is subdued. Yep, the labour market is loosening. Yep, unemployment is up. And slack is judged to have emerged in the economy. Now, this is one of the best reasons when you're not hitting the inflation target to cut the rate. And it may well have been the chat on the committee that got the 5 that did end up voting for the -0.25% cut. Preserving the fragile economic growth we're just about eking out in the face of weak and incongruent fiscal policy is the best the committee can do at the moment with the hand that they're dealt. The committee closes by referring to their ongoing approach as gradual and careful, that second adjective being used just to show you how careful it is. They also point out the future path really does depend on how much the underlying disinflationary pressures continue to ease. Now, I think this is a typo, and I think it's the first one I've ever spotted in the MPC report, because this is concerning. I'd have expected to see it picked up, but I don't think anybody can be sure, because I would have thought they mean underlying inflationary pressures. But if they're saying underlying disinflationary pressures are easing, I'm not sure which disinflationary pressures easing they're talking about. We've already seen energy prices come back down. We've already, all we're seeing at the moment is inflationary pressures. But who am I to comment as 9 very, very preeminent economists who've put that report together? So, but they do point out that the path of monetary policy is not preset and will respond to evidence. Now, you have to be a bit of a reader between the lines extraordinaire here. And I'd say it's the first point they've made that says subtly rates could go back up, if they needed to. That's the first time they've really hinted that for some time. But that doesn't really seem to have been picked up by the market, I don't think. Now, that's my opinion. That could be too subtle. I could be wrong about that, but that's where it is. So we're a long way in already with only being a page into the report, I'm afraid. But with that in mind and bearing in mind everybody's time constraints, I'm spending the rest of the time focusing on what's changed in the reporting in the past 3 months. And I also want to shine a bit of a light on some of the bank's DMP, that's the decision makers panel, new data. Right. So the bank now sees growth at 1.25% per annum for the next 18 months or so before improving. And they say that this requires household savings ratios to continue falling as people have been saving so much. So nervous are they as the future of the tax landscape at this time. Unemployment will continue upwards, says the bank. I agree, perhaps for different reasons. They also think that monetary policy is still restrictive, not helping the economy to push forward, according to market predictions of rates over the next 3 years. This is potentially a sign of a push to lower rates even further if the economy does start to struggle even more, which some are expecting. I'm still prescribing treacle and a squabble for 1% growth with mostly poor policies, with the occasional flash of growth injecting policy, which also needs to be credited to Reeves where financial deregulation is concerned, and Rayner and Reeves where planning reform is concerned. Their problem is that they are fighting against the other levers that Reeves has been pulling, or arguably has been forced to pull by those pathetic manifesto promises. So they've had cause to up their growth forecast to 1.2% for Q3 from 1.1%, and cut their 2027 growth forecast to 1.5 from 1.6. Their inflation number for this quarter we're in right now, Q3 25, is 3.8% now. They did predict 3.5, but we're already at 3.5 for last quarter, and last month we were 3.6, as you might know. 2.7 they see quarter 3 2026, which looks more realistic, but I would still personally have that starting with a 3, bearing in mind we're on an upward trend at the moment, and there's no big drops to kick in. We're going to have another April with significant inflation next year. I'm not sure how we get down to the 2 point something handle, but we'll get there at some point. I just feel it might be a bit further away than that. You've already got this 4% plus minimum wage rise baked in, right? You've got another 5% round of council tax increases, and you've got an index-linked April inflation coming in 4%-ish based on September 2025's number, which the bank thinks is going to be 4%, right? So they're more positive about the amount of slack in the economy in 2 years, in spite of seeing lower growth to that point, perhaps because they've seen the first piece of evidence of household savings ratio actually coming down, which it did in the last quarter that was reported on. But it was a huge 12%, and it came down to a huge 10.8, which is still absolutely massive in historical terms. Bank rates then before this report, market predicted were 3.5% for Q3 2026, which looks on because of weak growth and unemployment rather than controlling inflation, and 3.6 for quarter 3 2027. So they're still seeing 3.5% as the bottom of this cycle in interest rates, given everything they know at the moment. Is that likely? Well, it's definitely by no means a given, because the skill and the resultant pressure incoming with which Reeves delivers the upcoming budget is huge. It's actually bigger than last year because she had a one-off chance, and this is starting to look like needing to be a two-off, which is rarely forgiven in politics. So those that are predicting a low at 2.5% or so in this cycle, and there are some forecasting houses out there doing it, more cuts might be needed to repair the damaged economy that's limping forward. It's not that unlikely in my book. We would instead continue with a relatively stagflation leaning or stagflation light, if you like, environment. I only say stagflation light because unemployment is still so low historically, even though it's trending upwards. We don't have a recession baked in by any means, and in spite of weak guidance, in spite of no real plan for job creation in the private sector, and in spite of more concern to business owners and investors than to encourage them, the economy is limping on at this pace of sort of 0.75% growth a year, which will improve as it organically, because interest rates have already come down, and the further away we get from April 2025, depending on what gets whacked in this budget. Now, maybe I'm out on a limb here, and it's the first recorded time I'm saying it, although I have said this much on LinkedIn already. I don't think business is going to get it in the neck this time out. I think Reeves does know the damage is done, and if anything, there might be a shade of help for the sectors that have shed a lot of jobs on the back of business rates normalisation and have taken the minimum wage pressures harder than other sectors, restaurants, hospitality, retail, etc. That, of course, in a way that the economy is nice and basic, only leaves the consumers, the people, to take it in the neck. In many ways, Labour's only choice is to attack the savers one way or another. ISAs, pensions. I don't think helping people save cash in tax-free accounts looks anywhere near as attractive as it did with very low interest rates. Cash savers can just pay the income tax like everybody else. Imagine how popular I'd be in power. Once again, my 758th claim as to why I would never be elected. But if I was anywhere near policy, this is exactly what I'd be saying to the Chancellor. It's more a question of how politically that's communicated without attacking the middle class, a majority of whom voted for this administration, of course, and they're just the people Labour are hoping will still keep them in power as long as everything is going okay come 2028-29. The bank still sees unemployment topping out below 5%, but has fallen into line with my forecast of 4.8 unemployment by the end of this year, primarily because we're nearly already there. I'm not convinced we're not going above 5% now, and indeed I think 5.1 to 5.2 looks likely in this cycle, unless there's a bit of a turnaround in job creation or overperformance in particular industries. For example, financial deregulation will be helpful to growth in the upcoming OBR report. I don't doubt it, although no one's talking about it. But what it won't do is create a lot of jobs, because financial jobs are high value per head, whereas the industry is being carved up by national insurance rises and rates increases are low value per head, people-heavy sectors. Conveniently, the most important number of all, inflation in 3 years' time, if the rate moves as the market predicts, 2%. This number can be tolerably be below or above by about 0.5%, but it looks ever so neat as the 3-year forecast. I'm sure you'd agree. The path of inflation forecasting is so smooth as to be jocular, if I'm honest with you. I don't think we'll learn much more about the bank or the future by spending any more time on it. Moving to the decision makers panel as a bit of revision, this is a group of businesses of different sizes who report on expectations for inflation, wage growth, and other important metrics that the bank takes seriously. Pay growth by the end of this year, according to the DNB, just under 4%, which will still require some further moderation, but this slowing labour market has most certainly shifted the balance of power in favour of the employer. They see this as around 3.5% by the middle of 2026, which would very much be in line with normal and with 2% inflation. And on that basis is actually believable, especially watching the labour market mess unfold in real time, since these figures tend to be highly accurate, as they're coming from the decision makers themselves, not a forecast, but instead an aggregation of what some firms already have in their budgets or draft budgets. There's most definitely a difference. In a year's time, the DNB sees CPI at 3.2% for July 26, with 3 years ahead being 2.8% or so. Again, I could buy both of those. My own predictions are fairly close to that, to be honest. Much more believable than the bank's forecasts. Households are not far off, although they're more bearish, but that isn't stopping them saving their money. Arguably, the rates on offer need to get below inflation, although, even though they pay income tax on the interest, the savings they receive, it's just a bit of a psychological thing, really. You know, if inflation is 3.5 and you're only getting 3% by putting it in the bank, it's going to be a lot less attractive. You're only going to be saving for saving's sake, for rainy days' sake, not for investment sakes, if you like. Just because the general public is not that hot on all of that stuff, really. And of course, there's talk, and if you've seen it, about collecting interest income, so income tax on interest on savings via PAYE, other than anything else. So it's collected a lot more efficiently, which the Chancellor is keen on, of course. So the highest numbers that any of the forecasters that the bank report upon for the following metrics are GDP 2.2%. Someone forecasts that in a year's time. I mean, I'd love that, but what are they smoking, that forecaster? Unemployment 5.4. Well, that's pretty bearish. As I said, I'm not a little bit under that, but not a lot. And CPI 2.6, but I'm with the DMP and I see more like 3.25 or so. But I have no idea what the other forecasters are playing at, to be honest. They're certainly ignoring core inflation. That much is for sure. So the bank in 3 years' time think we'll be at 1.4% growth, 4.6% unemployment, and 2% inflation. And that would sit reasonably well, but I think it's too hopeful unless we see some more congruent policy from Labour pushing in the same direction rather than infighting and a lack of support from their broader base when it comes to fiscal responsibility. So before I do close for the week, don't forget to book your super early bird tickets to the next property business workshop that Rod and I will be running Wednesday, the 1st of October, Central London, investment metrics and how to run your property business at scale. My favourite topic of them all. Book at bit.ly/PBWEIGHT. There's also a link in the show notes. But whatever you do, please remember to keep calm, always listen to the supplement and carry on. There's going to be opportunities abound this year and towards 2030 and beyond. The landscape's basically set for a surefire bull run in UK housing. It's going to be slowish. It's going to take a little while to get off the ground. And as the amount of stock around is still keeping things suppressed at the moment, but as yields are currently continuing to improve, it's a case of here we go, in my opinion. Thanks, everyone.